Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It's lecture time, and this week's topic, guys, we're going to talk about proper trading, consistency, building a trading plan, tracking your trades, journaling your trades. We're going to talk about all that good stuff, understanding what a good batting average versus a good Sharpe ratio is, and we're going to merge it all together because I have a feeling a lot of you out there aren't doing any of these things, and you're wondering why you're not as successful as you should be, and the reason is because you don't do any of those things. And people hate it when I say this, but a lot of people, they're just better employees than bosses. And to be a trader, you need to be a boss. All right? So today we're going to talk a little bit about how to be a better boss, how to be a better trader, so that you can get out from underneath the thumb of your employer so that you don't have to work there forever, because I'm guessing that's why you're watching this video. All right, so if you like these videos, please click that like button, hammer that subscribe button. I'm Jared Wesley of Live Traders. Let's get to it. This week's lecture topic is trade management, proper trading, and consistency. It's a lot to take in, but it's also a little bit longer of a lecture as well. When I looked at it, I was like, wow, this ended up growing to quite a few pages. A lot of them are charts, but we're going to start off without charts, right? We're going to start off kind of, quote, in the book, if that makes sense. Then we'll get to quite a few charts. So it's kind of a mixed lecture, if you will. But I think it's a topic that a lot of people need some help on, because I don't think that most traders truly understand their actual trading. They come in, they're like, yeah, well, I take 3-bar plays. Yeah, I do this. But they don't really understand the minutia of what they're doing with regard to how expectation affects trade management, how personality affects trade management, what proper trading looks like, how to be consistent. So there's a lot to take in today's lecture. But before we do that, this is a rehash. I will let you know this specific "When Will the Insanity Stop" is a rehash, but it was a good one, and I thought we should show it again. It's from a while back, maybe 3 years ago, maybe 3 or 4 years ago. Basically, don't do this, all right? Lost life savings in the market today. Not sure what to do. I went long on an oil ETF Friday afternoon after oil took a huge hit Friday, thinking it would recover. I had a $175,000 position. I'm looking at it today, and it's $1,885. I've lost it all. Whoa, that hurts. I'm 28 and make $45,000 a year. Well, the positive is you're 28. You know, you have a long ways to save back that money in the future. The negative is making 45 grand a year and saving 175,000 is very, very impressive, right? I mean, you had to do something right to save that kind of money. The person goes on to say, most of that money I saved was from inheritance. Not sure where to go from here. I have proof of all the trades. This hurts. I also have a baby on the way and recently married. I was greedy and tried to increase my money, instead lost it all. This goes to two commentaries. One, it goes to a trading comment, use stop losses, and it also goes to investment commentary. You know, Anmol was talking about it a little bit yesterday, and that is shooting for the moon, right? And I said to you guys, I said, don't be, and I didn't use the word greedy, but don't get ahead of yourself. You know how we were just sitting here saying 6X on Berkshire Hathaway over the past 10 or 15 years was actually really good? And somebody was like, 600% return every 12 or 13 years of your life? Do the math on that, especially if you start in your 20s. Imagine every 13 years you 6X'd your money. Every 13 years. Do the math. By the time you're in your 50s, you got a lot of money. So my point I'm making is if you're a long-term investor, stop the GameStop horse shit. Stop the AMC garbage, right? Invest in quality stuff long term and stop trying to hit grand slam home runs, okay? Otherwise, you're going to end up being like this person. As a trader, right, okay, you need to take your stops, because if you don't, what happens? You bag hold, and when you bag hold, it gets worse and worse and worse, until you can't take the pain anymore, and then you finally get out of the position. Tell me that's not how it works. That's exactly how it works. And usually when you finally get out, it's nasty. Started off with a $100 loss, and now you're down 10,000. Yeah, crazy stuff like that happens to people. Okay, so you still think money management's a joke? Still not going to listen when I tell you to risk $10 per trade? Well, that's up to you. I can sleep well and easy at night because I know I tell people this every single day. And if you risk $10 a trade, there is no way on God's green earth that you can lose $175,000. It's impossible. But when you get ahead of yourself and get greedy, anything's possible. All right. And in this, I don't know how you guys would feel, but 45 grand a year, you just lost all the inheritance you were probably going to get for your whole life. That hurts. Because $175,000 at 28, park that in the market for the next 30 years till this person's 58, and they'll be a multimillionaire. Just that, just parking it, right? Oh well. Anyway, let's move on. Let's move on. Some of you guys have seen the next couple slides. Don't worry, we're going to move past this, but I wanted to start off with something basic and simple because while it is basic and simple, I don't think many of you actually understand what your expectation is in trading, what your expectancy is in trading. So let's talk about it just for a couple minutes before we move on into some other stuff. Number of winning trades divided by total number of trades is your batting average. People are like, duh, Jared, I'm not in first grade. I get that, but yet your actions show that you're in kindergarten, right? So if you had 50 total trades and 30 were winners and 20 were losers, well, you'd have a 60% batting average, right? 60% wins. The question is 60% batting average good? That's the point of the slide. Is it good? What do you guys think? Is that a good batting average? Yes or no? 60%. Good batting average? Some of you guys have been paying attention for a while. All right? In fact, almost everyone that's answered is paying attention. Zach, and some of the answers are wrong, like depends on your risk level. Well, no, it doesn't really depend on your risk level. The answer is it depends. It's just not on your risk level, okay? But yes, the answer is it depends. The question is, what does it depend on? Well, depends on how much you win when you win. You can have a 60% batting average and be a losing trader. You can have a 90% batting average and be a loser. Where's Yaroslav? Yaroslav, where are you? No, I'm not trying to harp on you, but I mean, we talked at mentorship. You could have one or two losses, literally one or two losses out of 50 or 100, and that one loss could wipe out everything. That goes back to the when will the insanity stop, right? Goes back to bag holding, okay? So, no, 60% batting average in and of itself, by itself, is meaningless, literally meaningless. Okay? Because if the 40% of the time when you lose, if you lose more than when you win the 60% of the time, you're a losing trader. So don't get caught up in just batting average, okay? And then we go to this, win-loss ratio, Sharpe ratio, whatever you want to call it. You know, it's the average size of winning trades divided by the average size of losing trades. So for example, if you have winning trades, say $170, $700, $30, $300, those are your winning trades, those four trades. And your losing trades are this, minus 350, 450, 75, and 90. Well, guess what? If you added all those trades together and divided by 4, it's 1,200 divided by 4 is $300. So the size of your average winning trade is $300, okay? The size of your average losing trade is 193. So your average winning trade is 1.55 times larger than your average losing trade, right? So your average winning trade is about 1.5 times bigger than your average losing trade. Is that good? Is that a good win-loss ratio? Yes or no? I'll put some dots in here. Yes or no? Is that a good win-loss ratio? It would be great for you, Steve-O. It would be. You're right. For you, it would be. It would be. The answer is, it depends. It depends on what your batting average is. What if you're batting 27%? Now is it good? Is it good? No. Right? If you're only winning, let's just call it 25%. If you're only winning 1 out of 4 trades, and when you win 1.5. Well, that's not enough to offset the 3 losing trades, is it? So when people say, well, yes, well, it depends. Meaning, the whole point of this discussion is one without the other is worthless, is meaningless. You have to have both. You can't just have a good batting average. You can't just have a good sharp edge. You have to have both, right? And they have to coincide so that when put together, there is a positive expectancy. And a good expectancy, for you guys that are unaware, is 0.2 to 0.5. I'll type that in. 0.2 to 0.5 expectancy, if I could spell expectancy, for an intraday trader is good. 0.2 to 0.5. And you're like, what does that mean? What that means is every time you take a trade, if you make 0.2R or 0.5R, every time you take a trade, that's good. And you're like, well, that's impossible, Jared. I have losing trades. Right. But the average says, on average, every time you take a trade, you make 0.2R. Winning trade, losing trade, you make 0.2R. That's good. That's on the low end of good. 0.5 is on the high end of good. If you're right in the middle at 0.3, 0.35, that's fantastic. That simply means for every 10 trades you take, you make between 2 and 5R. That's what that 0.2 to 0.5 expectancy means. For every 10 trades you take, you make between 2 and 5R. That's very good. That's very good. So you need to have a positive expectancy to make money in trading. And you'll get that positive expectancy by having a win-loss / sharp ratio and a batting average that coincide with each other. So that takes us to the next question. What's more profitable? Okay, what's more profitable? 50% batting average with a 2.0 win-loss ratio, or a 60% batting average of 1.5? Okay, which is better? Give it some thought. Take a minute. It's not meant to trick you. It's meant because if you know this, the answer should come very quickly to you. But if you don't understand, that means you're not doing it. That's the whole purpose of this slide. It's not to trick you. It's not to do high-level math. It's to simply say, if you take a long time to answer this, you don't deal with win-loss ratio and batting average very often. You don't think about it very often, because you should have this answer down pretty quickly, especially if you're an intraday trader at Live Traders, because we talk about 2R all or nothing frequently. We talk about 50% batting averages frequently, okay? So the answer is pretty much identical. There might be a very, very subtle difference, but for all intents and purposes, they are identical. Do the math, right? Do the math. 50% batting average. 5 winners gains 10R, right? 5 losers loses 5R. Net, after 10 trades, you'd make 5R. 60% batting average. You have 6 winners. You only gain 9R instead of 10, but you also have fewer losers, and you lose 4R. Net, after 10 trades, you make 5R. The verdict is they are the same. 2 different ways to get to the same place. Now, are they somewhat similar? Yes, they are. One person is basically saying, look, I feel comfortable selling earlier. And in doing so, because I sell earlier, I'm also more accurate. Right? I mean, if you sold for a penny, you'd probably have a 95% batting average, right? If you just sold every trade for a 1 penny gain, you'd probably have a 95% batting average. But that 1 penny gain is not going to be enough to offset the 5% of the time that you lose. Right? In this scenario, it's just 6 of this, a half dozen of that. It's the same thing. The reason I'm showing you this, okay, the reason I'm showing you this is because you need to know. If you have a 72% batting average with a 0.7 sharp ratio, you need to know if that makes money or not. Because you might feel good when you win 72% of the time, but when you only win 0.6 or 0.7 R, it might not be enough to make you a profitable trader. In that scenario, it's going to be very close to break even. Okay? So the point, though, is understand this stuff or potentially be a losing trader. Why? Because you need to understand what expectation is. You need to understand what your approach provides for you. So if you know that you're shooting for 2 or 3 to 1 targets, you also should know that your batting average is likely going to drop a little bit compared to someone who's shooting for 1R targets. 1R is easier to get than 3R. The only question you need to ask yourself is, does the offset work? Meaning, me waiting for 3, is it more profitable to do that, or is it more profitable to do 1R? The answer is, it depends on how accurate you are. Some traders are very good at reading charts, some are not. So for some traders, they might want to shoot for higher targets, say 4 to 1, because they're not that accurate. For somebody else who's extremely accurate, you might say, well, I can shoot for 65 or 70% batting average with very small targets because I'm very accurate. So you need to find that balance in who you are as a trader. And if you don't track your trades, you'll never know the answer to this. And let me guess, most of you don't. Most of you don't. And that's your loss. You run a business here. I'll say it again. I use this term in mentorship all the time, but it's a business. Treat it like one. You run a business. There's no way if you were an employee at a company, they'd let you get away with not tracking sales figures, not tracking expenses, etc., and so forth. So why don't you do it in trading? You have to do it. Otherwise, you don't know where your happy point is. The happy point is where the mind meets the profits. What I mean by that is you find a management strategy that you're comfortable with, you're not struggling to do it, but also makes you money. You have to find that balance. Find that positive expectancy. Know your expectation. Unless or until you do that, you're just Elmer Fudd, shooting bullets in the air at nothing. Okay? So figure that out or struggle for a while. So if you had to choose a management strategy that is balanced but makes good money too, what would it be? You can only pick one. Well, guess what? It's a trick question, isn't it? Because it just depends. Most people are like, oh, I'll take 2R. Why? It's right in the middle, and you said so. But what if you're just not good at that? What if you can't hold to 2R? Well, then 2R doesn't make much sense for you, does it? What if you want to hit 1R, but you're really not very good at picking stocks? Well, that's not going to work either, is it? So you're either going to have to find a management approach that works within your deficiencies, right, within your dysfunctions, or fix your dysfunctions. I'll repeat that because it's important. You either have to find a strategy or an approach that makes money within your strengths and weaknesses and dysfunctions, or fix those weaknesses. One of the two has to happen. Both would be great, but one of the two has to happen. Okay? And there are times where the market doesn't give that. But again, we're talking over the long run. You may have to make certain minor adjustments here and there, but most traders will find a strategy that works well for them over the long run. I mean, look at Cliff. He's been doing this probably close to 15 years. He hasn't really changed his management very much throughout his entire career for the most part. He does 2R targets. He goes to break even at 1R. And it hasn't changed. This market, that market, the other market, doesn't matter. Right? So you can find something that will last, the test of time, but you have to be able to do it first. All right. So let's dig in a little some charts, okay? All right. What is this? It's not a trick question. It's not a trick question. What is this? Okay. What is this? Again, not a trick question. It's a 4-bar play. Thank you, Andre. It is not a bear sandwich. Okay? It's a 4-bar play. We have a wide range. Was this really that hard? Seriously, was it really that hard? How can it be a 3-bar play when there's 3 resting bars? And in a 3-bar play, there are only 2 resting bars, and the 3rd bar triggers the entry. So how could it be a 3-bar play? It's a 4-bar play. Okay? So it's not a bear sandwich. It's not a bear sandwich. A bear sandwich has to be a 100% engulfing bar. This is not. So we have a wide range green bar that takes out the topping tail, takes out some of this resistance to the left. Then we have a semi-narrow range bar because it's not really narrow range, right? It's about 70% of the size of bar number 1. Then bar number 3 over here is in that upper 50% that we need. So what we're seeing here is a stock put in a wide range igniting bar, then a resting bar that closes in the upper 30%, right? It closes in the upper 30%. And then a third bar that closes in that upper 30% as well, that's green and takes out the red bar. This is a very nice 4-bar play. And I'm a little surprised at how few people got it. Literally one person got this right, Andre. Andre is the only person that got that right. That's unbelievable to me. Shocking, actually. Anyway, that's what it is. Now, what does it turn into? What does it turn into? Well, if you look at the top left corner, it says TTD, but yes. What does it turn into? If you couldn't get the 4-bar play, I'm going to be really worried about this one. What does it turn into? Yeah, it turns into an ascending triangle, right? Flat top, higher lows, flat top, higher lows. Okay? So what started out as a 4-bar play turns into an ascending triangle. Now, to be fair, if you like the 4-bar play, you are already in it over here. So now I'm commenting because a lot of people use the tightest stop possible on 3-bar plays, and I always tell you guys, give them room. You can always add back, and if you can't add back, then at least you're in a safer entry. Okay? So when you look at this, it peekaboos over and then pulls back, chops and chops and chops, but it continues to put in higher, low, higher, low, higher, low, and you get the ascending triangle. Okay? So this was called, right? Bull/ascending triangle. Flat top, higher lows, 232. Now remember, if you're already in it, you're already in it, but we were not already in it. Okay? TTD 232 by 229, first target's 235. That's a good, solid trade that went from 232 to actually to 245. Right? This thing went $13 on a $3 stop loss, went over 4 to 1. We got our first target pretty quickly, bounced, pulled back. But this is a good play. The comment, though, I want to make is that sometimes stocks do this. They get a little bit choppy. Okay? And where I'm going with it is, one, give the initial trade the room it deserves, especially this early in the morning. We're on a 2-minute chart. That trade triggers 2, 4, 6, 8, 10, 12 minutes in, like 9:40. 9:42 is when the 4-bar play triggers. Okay? Then this trade, which was called quite early, right, eventually triggers just before 10:30. Let's call it 10:26, 10:28. Okay? But if you got into this initial trade, you could now adjust your trade. If you had too wide of a stop, say you used low of the day, now you can tighten it up to here, right? If you had too tight of a stop, you probably got stopped out. This then becomes an 84% re-entry play, right? If you took the first trade with a stop loss that was too tight, you could have re-entered over here and took the second trade, got your money back. But this is what good trading looks like. It's being patient, waiting for your pitch, waiting for a stock to show you what you want to see, right? Remember in mentorship we talked a lot about let it come to you. Don't chase it, let it come to you, okay? And this trade eventually made, I don't know what it made, $800 or $900, maybe $1,000, I don't know. But this is that TTD trade that I was talking about. And a couple others, BYND and whatever. So anyway, you don't need to see that. It's not important. But the point is that's what good trading looks like, right? Consistent trading looks like. Over here, what do we have here? What would we call this? Talk to me. A buy setup, right? Okay. So one of the things that I tell you guys all the time, and I'll continue to do so, is cover the future. Cover the future, because you don't know what the future holds. So cover the future. Do this on all your charts at the end of the day. Cover it. Right? Then you can kind of look and see, well, was this a good play? So what we have here is a stock that gaps up, puts in a wide range green bar, a couple bottoming tails, then pulls back, puts in a massive bottoming tail right here, followed by a higher low bottoming tail, followed by a little bit of a topping tail. Okay, so when you look at this, you have a buy setup. If you're using the high here and the low here, it's about a 50% retracement. Okay, so when you look at this, what should have you interested in this is the bottoming tail. However, there are some concerns. You really, really don't want to see a stock break below a wide range bar like this. I mean, this is a bar that went from $87 to $89, a $2 bar. And while I do really like the bottoming tails, multiple bottoming tails, breaking below the prior bar's low is a bit of a concern. So this is a little bit of a conundrum play. This is the type of play where you might nibble some, right? You might get in over here and maybe give it the extra room. Give it all the way down here, right? Because you're going to get a bounce at some point. You can see the bottoming tails. You will get a bounce. It's unequivocal. You'll get a bounce. The question is, how much of a bounce will you get? So this trade, a lot of this trade, depends upon expectation. You know, if you're looking to get a buck out of this thing, you're probably okay, right? You know, get in at like 87.50, maybe you're looking for 88.50, maybe, probably okay, okay? But there are some challenges here. It's not perfect. But those bottoming tails are tempting, aren't they? So, long story short, there you go. What happens? You get the scalp pop. You get the scalp pop. And then you retest, get another scalp pop, and then puts in a low, right? So I called this trade over here, 87.50 by 86. I gave it extra room, okay? And it didn't go the $1.50. It basically went, what, $1.30, $1.20? Just kind of missed that area right there. Pulls back and retests, gives you another one of those 75-cent to $1 pops, okay? But again, starts to go lower, and we don't know the future. We do know it didn't go below $85 because I should have probably put this a little bit lower. But this is also an area where the stock bounced from this morning as well. So we know buyers, if you think about the $86 to $87 area, buyers have been stepping up. The first bar of the day, the bottoming tail, the bottoming tail, the bottoming tail, they've been stepping up in this area. Okay? So if it's in your plan, consider an 84% play. Right? This stock held this area. Would I buy it at 80? What is that, 86? I don't know. It's pretty choppy. Okay? It's pretty choppy. The point I'm making is you'd be surprised how often second entries work. I know many of you have heard the 84% play. It's in PTS. It's nothing new. But I haven't talked about it in a very long time. It's probably been six months. Beginning of the year, it's been the last time I really talked about the 84% play. So if you find yourself in a trade that stops out, consider re-entering where you got in. However, like I said before, you better know the statistics. So I would back test this before you actually apply it. And in this case, it ended up going not quite to full target. Maybe it did. Maybe it went to full 90.50, which is $3. But the point I'm making is keep it. Keep it in your toolbox, but back test it. I'm not trying to push it on you. For you, it may not work very well, right? But something to keep in mind, all right? And for me, I did the 84% play on this and got my money back, all right? It's a small profit because I'm getting my money back, if that makes sense, right? So I got back in this. I took the original trade and stopped out, and I got my money back. You can see the closed P&L versus the open P&L, getting my money back on the second trade, all right? Whoops, where did I go here? Hold on. Now, good 3-bar play that didn't work, right? Maybe I should put this in yellow. Let's do that. Put that in yellow. Bam, right? What do you guys think? Good 3-bar play that didn't work. Wide range red bar takes out support right here, okay? Goes lower, puts in a narrow range resting bar that initially goes lower, pops, pulls back, pops, and then chops out for the rest of the day. Just literally just chop, 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 chop. 417.50 by 423.50. Looks good, right? I mean, wide range bar, again, doesn't look overly extended down. You know, if you look to the left, I mean, this is a big bounce. This bounce from yesterday is a bottoming tail, right? If you think about it, this stock gaps up and goes completely red. Remember that visualization, guys, okay? This is something that you need to do, all right? Let's do it. That right there, okay? Hold on, bear with me. That is this. That is this whole move, okay? That's what this looks like, okay? At the bottom right there, that's what it looks like. It looks like a gap up that just goes red, 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 okay? Right there. Then, what happens? The red comes to about there-ish, about an 80% retracement. Let's call it a little more. And then basically, that looks like that. So at the end of the day, what does it really look like? If some of you are confused, don't worry. Give me just another second. I'll sort this all out, and we'll be good to go soon. If I could get that to straighten itself out, that'd be even better. Okay, so now, that's basically, right? That's basically what this did. Okay? Gaps up, rolls over, becomes a full red bar. Full red bar. Then, right over here, okay? Right over here, it starts to climb. Climbing means green. And green means bottoming tail, bottoming tail, bottoming tail, bottoming tail. Now, granted, at the end of the day, it did sell off right late in the day. All right? So maybe this is more akin to that. Okay? Something like that. I don't know. But you get the point. Okay? Then what happens? The next day, you wake up. Right there, it opens right there, and then it basically does that. Right? Are you guys following me here with these bars on the left? Just give me a yes or no if what I'm saying makes sense. Are you following what I'm doing here? This is a 5-minute chart, but I'm letting this be the daily. These big bars are what the daily would look like. Okay, good. So now the next day, this thing just gaps pretty, gaps down a little, right? Gaps down a tiny bit. And then just goes lower, 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 lower for the first 15 minutes of the day. Okay? So the reason I do this, and I did it at mentorship for you guys, is I need you guys to realize, imagine, or visualize how moves are forming. What does it look like on a different time frame? And this is what it looked like. It looked like a big red bar, then a green bar, then it basically left a bottoming tail. And then the next day it comes in, and it just is red. Now, obviously, it changes throughout the day because this is a 5-minute chart. But this is what it looks like. So let's get rid of this. So, all right. Now, that's what it looks like. So, in a vacuum, this looks pretty damn good. Looks pretty good. And it looks really good until you do this. Right? Then you're like, shit. I didn't look to the left. I didn't look at the higher time frame. Right? Let's do this for a second. Let's just do this. Just bear with me. I mean, what in the world are you doing? Right? This whole area, support. What in the world are you doing? Not good, right? Not good. So I'll pull this off. And this is what happens when you don't use multiple time frames and you don't look to the left. Okay? So we got that bar and it broke yesterday's low. That's good. Right? There's that bar again. And you get into this 3-bar play and you realize you don't have any room. I was like, there's no room here. Double bottom on the 5-minute. Then on top of that, you can see the 60, the gap up. Again, that's right here on the 5. So you need to be smart. Right? This is laziness, in my opinion. This is vacuum trading. This is trading without having multiple time frames on your chart. At mentorship, you guys remember what I told you? I said you better have all 4 time frames on your monitor at all times. I don't care which monitor it's on, but a monitor that you look at frequently. Anytime you go to take a trade, your eyes should immediately scan those 4 time frames and go, okay, I've checked them. Then this won't happen to you. This won't happen to you. Because we all get caught up sometimes in a 5-minute or a 2-minute chart. I've done it before. I did it this year. Got into a trade, and you're like, man, it looks good. Jump in. Why? Because you're like, I'm about to miss it. I better jump in. Didn't glance at the 15-minute, and you're like, shit, I'm right at support, right at resistance. Okay? So have the 60-minute up. Have that 5-minute. Have that 15-minute. Have that daily up so that this doesn't happen to you. Okay? Because it's a real thing. We get so caught up in like, oh, wow, it's such a nice 3-bar play. Let's just jump in it. Especially if you see it late. If you see it late, then it's much easier to do because you're like, oh my gosh, I don't have any time. I got to figure out, I'm in. Wow. That happened fast. Nope. That's when you have to step back. And to a lot of you that I spoke to at mentorship, I said, I don't care if you missed the trade. I'd rather have you go through your checklist first and miss the trade than not go through your checklist and take a bad trade. Go through your checklist first. All right, now, 2-minute, 3-bar plays. Any issues? The only issue that you should be seeing is the fact that the gray area doesn't go low enough, right? But here, there's no real issues, right? You have a gap down that's not excessive. It's like a $4 gap on an $80 stock. That's nice. You have a wide range red bar. That's nice. It's not too excessive. It's got a doji bar that's kind of in that bottom 50%. So in a vacuum, looks solid. In a vacuum, looks pretty decent. But we don't trade in vacuums. We don't. Okay? Now, I anticipated this trade. Okay? I looked at the pre-market chart right there, and I'm like, okay, this thing is consolidating. It looks lower. There's the 2-minute, wide range bar, narrow range bar. What do I get? I get another one. There's the 1 minute. There's the 15. I'm looking over here. I'm like, so far, not bad, right? So far, not bad, right? I mean, it's doing what I want it to do. 3-bar play on the 2-minute triggers, and you take, let's see here. Hold on 1 second. Let me just snip this out real fast, just so you guys can see. Give me a second. So if you take that, and if I blow that up, how do I zoom again? I always get this messed up. Control plus, that's it. All right. All right, there we go. That's pretty good. Solid start to that trade. Wide bar, narrow bar, and it's moving down 33 cents. And you can see it right on the left-hand side here. Right to the left. It's down there. Okay? So far, so good. All right, now, no problem so far. 15 minutes below that, I got this little, see that 1 minute chart? You're engulfing the bottoming tail, even better yet. Moving this area, and shit. Right? Shit. That happened. Like, what? What just happened? Well, shit happens sometimes. Okay? Sometimes it's not much you can do. Right? I mean, it certainly looked like it went, I don't know, maybe close to 1R, right? I mean, that looked like about a 50-cent stop loss maybe, somewhere around there. And it looked like it went about 50 cents. And you can see I closed out for a very small gain, right? I closed out for a very small gain. So my point I'm making is, if you get into a trade and it's a good trade and it does this to you, you follow your rules. Period. End of discussion. Where I'm going with this, you're like, I'm lost, Jared. Where are you going with this? Sometimes random shit happens. Like, I could never have foreseen a wide range green bar that's like 80% of the size of the move happening. I couldn't foresee that. So where I'm going with this, for those of you that are still lost, is I don't care how shocked you are. I don't care how surprised and unexpected the move was. Take your stop. Follow your plan. Whether you trail out at break even, whether you take a full stop, I don't care. But don't get caught up in the emotions like, oh my gosh, that happened so fast. No, you had plenty of time to place your stop loss. You got into the trade, it went lower for 2 minutes, came back up for 2 minutes. You had 3 or 4 minutes to place a stop loss. Don't make excuses for stuff. Don't be like, well, that's crazy. That's going to come back down. That's unusual. No, just take your stop. Deal with it. Otherwise, it could go all the way up, 83, 84, and you'll be bag holding. And then you'll be checking the news tomorrow and seeing what the CEO said and seeing when the next earnings report is and seeing if it's on Jim Cramer. You will, trust me, because you've done it and you know you've done it. Don't. It was a good play. It just didn't work out. Let me repeat. It was a good play. It just didn't work out. All right? This wasn't 10 o'clock. This is a 2-minute chart, right? This is like 9:40, okay? But, yeah, and then you don't want to be listening to earnings calls and conference calls. It was good. And maybe you got out for 1 hour. Who knows? But my point is, just admit that for whatever reason, it didn't work. It wasn't necessarily a bad trade. It just didn't work. Okay? Stop the justification game. It's going to get you in deep, deep, deep trouble. Okay? Now, here's the higher time frame. Okay? Went 53 cents. You were right, Chris. 1.06R, then stopped full. Okay? There's the play. Nothing terribly inherently wrong with this trade. Here's the 60-minute. We're breaking under support. See the support area at $80 right here, right where my cursor is? It should have had room down to like 72 or 73 bucks. There's nothing terribly wrong here. It just didn't work. And then it went sideways for the entire rest of the day. You can see it on the 60-minute. It just went dead sideways. And you know what? It does that sometimes. How do I know? Because I can see it over here. It dropped, then went sideways, right? A couple other days, dropped, then went sideways. So whatever happened, happened. Remember, support and resistance are areas. Areas, areas, areas. Well, clearly, the $80 area was not done being bought up yet. While we did break below 80, and that was below this area here and below this over here, clearly the institutions felt differently. And they thought, well, it's still buyable at $79.50, $79.70, and they bought it up. Walk away. Walk away. All right, do it again. IBM. We have a gap down that bullies, and after the bully, okay, well, it didn't even trigger on that, Val. That's good. Didn't even trigger. All right, we have a gap down that bullies and then gets completely engulfed, okay? Not knowing the future, would you have taken 84% play immediately after having been stopped out there? Seems a bit early for me. Would scare me. Then you don't understand the 84% play. I'm not being rude. I'm simply saying. It's like this. You hit on 17 or you hold on 17. You don't sometimes do it and sometimes not do it. You just do it, right? If that's what your plan is, that's what you do. Yes or no, Antoine? Like when you use the word seems a bit early for me, well, then you don't do the 84% play. Plain and simple. You either back test it and it works an acceptable amount of the time, or you back test it and it doesn't work an acceptable amount of time. And there's no gray. It just is. Now, could you back test it in more detail? Perhaps. You could back test how the 84% play works after 9:45 versus before 9:45. You could do all those things. But as a general rule, your stats will tell you whether or not you're allowed to do it. There's no seems or I think. It just is. The numbers either work or don't work. That's it. Okay? So, this is an engulfing bar. Takes out the green bar. All right? Cool. No major issues there. We get in as a 1 minute turnaround bar, which was a little bit aggressive. Okay? Based off of this breakdown on the 5 minute pre-market. Okay? So the 1 minute turnaround bar was aggressive, but a gap taking out some moves to the left, and again, taking out the 114 pre-market area. Okay. Stock goes down, right? Obviously took a little bit off the table. I see some closed P&L there. And then this happens, right? It went 1.46 or 0.97 R, then stopped full. Went $1.46. Okay? I don't know why it says cents there. Let's just change that to like, whoops. There. Went $1.46. Just under an R, and then turned around. And this is a play that would have also likely tagged your 84% play. So right there, if we were to draw a line right across here and say that's your entry point, you would have been re-triggered in this. Let's make it like pink so you can see it. You would have been re-triggered into this trade over here at 11 o'clock. And it would have ground out a little lower and then bounced back up. I don't know how it finished the day, but you can see sometimes stocks do everything you want them to do, and sometimes they don't do what you want them to do. And some people move to break even at 1R, and you're a few pennies from 1R. Where I'm going with this, guys, is you have to be consistent in your approach. You're either going to do what your plan asks of you, or you're going to be a losing trader. It's that basic. You're going to do what your plan asks of you, or you're going to be a losing trader. So give that some thought. I talked about it at mentorship. Do you like your boss that much? Do you like your job that much? Do you like having to ask when you're allowed to take vacation time? Do you like being asked to work overtime? Do you like dealing with idiot coworkers? Do you like all that stuff? Because if you do, just keep breaking your plan. Keep going against everything that you spent all that time writing down that's there to help you and guide you to success. If you don't like any of those things I just talked about, you might want to start following your plan. And where I'm going with all of this is, there will be times that your plan infuriates you. Like when it goes 0.97 R and stops you out completely. You're like, I was 2 pennies from break even. Now I took a full stop. Oh, well. If you believe in your plan, then it shouldn't matter to you. You know, it's like when Unmal said, and it was kind of funny the way he said it. He's like, AI doesn't chastise itself. Computers don't chastise them. They don't go, bad AI, don't do that. They just are. The program just is. It's programmed to do something, and it does it. You know? That's it. It doesn't say, good program, bad program. Do you want a cookie program? No. It just does it. It doesn't ask, it just does. You guys sit here and you start messing with yourselves all the time. No, I don't mean that way, Sophie, relax. I mean, you have to stop questioning it. And the only time you're allowed to question it is when the statistics give you adequate data to suggest you need to make a change. Repeat that last part. The only time you're allowed to question your plan is when you're tracking everything and you go back and look at the data and there's a valid reason, a large enough sample size to go, yeah, I need to make a change, an adjustment, because over the last 500 trades, this is working better. That's it. That's it. Otherwise, it's just all subjectivity and your mind playing games with you. As I've said before, trading is a mental mind F. Fill out the other 3 letters. That's what trading is. It's a mind F. Okay? So, ZM, pre-market consolidation. Stock chops around, looks pretty good in the pre-market. Right there. Pre-market. Right there. Then the market opens. Okay? So far looks pretty good. Okay? Looks pretty good. Now it looks really good, doesn't it? All right? For you as a job, only have a... Yeah, that's what they do, Rob. You know, Chris is saying, for me, I like to keep the stop tight on plays like 3 bars or buy setups. Either move, stop to break even at 1R. If it has some room, trail it out. Yeah, that's fine. And see, Chris, what I like about what you're saying is you're looking at it and saying, hey, when I back test this, this is what should happen. Right? We talked about that at Mentorship too, expectation. What should happen in a 3-bar play? What should happen in a climactic? Well, they may have different things that happen. So you treat the trades a little differently sometimes, right? Meaning giving it a tighter stop, giving it more room, what your expectation is for the target, etc. So anyway, back to ZM. Beautiful pre-market consolidation. Moves up a little, consolidates a little more. By the time the market opens, basically 5 minutes into this thing, rips. So to someone who is not looking at pre-market charts, you're going to say, there's no pattern there. You literally bought this little red bar bottoming tail. You bought the high of it for no reason. Right here, let me put a little arrow on it. That little red bar right there, okay, that arrow is on. That's the first 5-minute bar of the day. And some people will go, you just bought the high randomly. That's dumb. That's crazy. That's aggressive. No, we didn't. Didn't do anything of the sort. We actually bought a nice lengthy, like 2.5-hour consolidation in a tight range with volume. So when the market opened, or right before it opened, or right after it opened, 155 was a nice spot. Gave it extra room because it's whippy off the open. Instead of giving it under that bar, which you could have given it 154. Just thought, give it more room. If it works, it's got a lot of room to go. Well, it went from 155 to 170. It went $15 on a $2 stop loss. Moved up, pulled back, moved up, pulled back, moved up, pulled back. And it was taken based off of a pre-market consolidation. Not a single bar in the pre-market, but a 2-hour consolidation, right? That's good trading when you base it off of something more than like a 1-minute time frame. Now, the flip side of stuff happens too. Shit happens. You get into a trade and you sit there and you're like, wow, look at this big bottoming tail. And it broke the low. I'll be honest with you guys. This pattern you're seeing on the 2-minute and 5-minute almost never fails. Almost never fails. Okay? When you have a stock that's gapping down, in this case it was gapping from like 151 down to like 145, okay? So a $6 move. Not crazy on a $150 stock. But what happened? It immediately left the bottoming tail. But the bottoming tail got engulfed. Most of the time, this trade works and works really well. Anytime you see a big bottoming tail and then it gets completely engulfed, they usually go lower. So I felt pretty comfortable taking this as kind of a pseudo 3-bar play, 2-minute breakdown, etc. and so forth. All right? But what happens? You get peekabooed in right there, and you get peekabooed, not peekabooed, but you get taken out over here, right? So we give it the wider stop. See the 142 area, just above that area, and you get tagged right there. See it right there on that topping tail? Then you get right back in it and then get tagged again. Or you gave it the wider stop and you got tagged right here, and then you get back in on the 84% play right here and get tagged over here. That's it. Oh well. Double whammy. Anticipation stop on the first one. 84% play stop on the second one. You're down 2R today. Oh well. It's going to happen sometimes. Follow the rules of your plan. Track your trades. Know what it is that you're doing with your own trading. Because if you don't understand your own trading, it's going to be hard to improve your trading. I'll repeat. If you don't understand your trading, then it's going to be hard to improve it because you don't understand it. Okay? Now, what's the thought process here? There's two arrows. There are two arrows. What's the thought process here? Talk to me. Talk to me. What's the thought process here? Excuse me. We have two higher lows, kind of lower highs, strong support point, higher lows, buyers stepping up, higher lows, clear support, double bottom with higher lows. Well, I think we can all agree that this area of 1,245 right there is being defended, right? Buyers stepped up over here one time. Buyers stepped up over here the second time. And now, potentially, they're looking to step up again. You can see a little green bar here, a little bottoming tail. Okay? So when you look at this, it's kind of interesting. Because some people might look and go, well, that's a bearish wedge. Some people, right? But you also have to respect the fact that 1245 is being defended quite strongly. The price on that stock is crazy, not for you? Yeah, but forget about the price. It's about the concept. So when you look at this, it's tough. To a new trader, they might go, oh, that's a wedge. But to an experienced trader, you're looking at this going, it's defending this area too strongly. And when it's bouncing back up, while it is a lower high, it's like a 90% retracement right there, right? This first retracement was maybe 50, 60%, 50%. But this second retracement, remember, it failed to put in a lower low, so it's a higher low. That's bullish. The 90% retracement into the prior pivot, that's bullish. This retracement, guess what? Higher low, that's bullish. You have to start looking at this going, the bulls are stepping up sooner and lasting longer. They're stepping up sooner and lasting longer. Okay? Stepping up sooner, we don't know yet. This is what happened. Okay? This is what happened. Chops, boom. Now, the question is, what would you do right here? Where my cursor is, I'm leaving my cursor right there. Would you buy that? Would you short that? What would you do? Would you sit on hands? What would you do? What do you guys think? Right where my cursor is. I'm leaving kind of my cursor right in that area, right there. A lot of people that are uncertain. They're not sure, right? This is a tough one. It is. Because you're looking at it going, well, gosh, it could be a flag and it could go lower, right? But you're also saying to yourself, it's probably not going to break 1245 because of the higher lows and all the support. When I look at this, I would stay away. It's too indecisive for me. So you might look at it and go, wow, there's a little bit of a flag there, right? I mean, and you could make that argument, right? You could sit there and go like this, right, like that. And do that, right? And then you go, oh, well, maybe it'll go lower. But there's a lot of support down there. Buyers are stepping up. It's defending an area. Okay. I would sit back and just let it go. As tempting as it is to go long, as tempting as it is to go short, I would probably wait. And what would I wait for? I'd probably wait for this and put in a higher high and then a higher low to support, and probably get in at 12.55. Sadly, it only went to like 12.59, right? And then it failed and then went higher later. But that would be a more viable area to buy it, where after it put in a higher high and a higher low, and the higher low is at support. Okay? The point, though, here is you don't have to have the answer every time. If you're not sure, and Rob is saying that right now, there's 5,000 other stocks to choose from. Let's choose something that's a little bit more clear, something that is easierly, that's a good one, Jared, that is easier to define, easier to read, easier to understand. You don't have to take this, okay? So when you look at that, you have a decision to make. Sit back, chill out, follow your plan, okay? Follow your plan. You don't have to be right all the time. So get your ego and push it aside. You don't have to understand everything all the time. And that was a big aha moment for a lot of people at mentorship. Like, I don't have to know. No, you don't. Because when you don't, you just move on to the next chart. Find a chart that you do know, a chart that you do understand, a chart that you do recognize, a chart that meets your trading plan requirements. Then trade that. If you're not sure, don't trade it. Okay? So, you guys saw this slide last week, I believe. Be robotic. Focusing on dollars once in a position is a trap that leads to failure. Planning each trade before you take it allows you to set and know your maximum loss, entry, stop, target. Once the trade is entered, you should have completely accepted the possibility of the maximum loss, including slippage. Hey, take the stop, move on. If you cannot accept the maximum loss, decrease share size or don't take it. Plain and simple. The only thing a trader needs to focus on after entry is the chart and market environment, or other charts. Robotic indifference. All emotion should be removed from the decision-making process. All emotion should be removed. You need to do these things when you get in a trade, and the way you're going to get there is a proper trading plan. And then you're going to gauge and measure the trading plan with your trade tracking spreadsheet and journaling. And you're going to put all of those things together, your plan, your tracking spreadsheet, and your journal, and you're going to have a lot of information in there if you do it properly, and it'll help you fine-tune your approach to trading so that you can meld it and merge it with your personality, and then ultimately become a more profitable trader because of it. But if you don't track those trades, if you don't journal those trades, if you don't have a trading plan, well then good luck to you. You're not going to do very well. And if you can't manage to put that shit together, you're in the wrong business. You're a better employee. If you can't manage to do those three things that I just said, trading plan, tracking sheet, journal, go be an employee because you're better at that. Because clearly you need your hand held. And a boss will do that for you on Saturdays and all, overtime and all, for the rest of your life. So you don't have to worry about it. There's a boss out there waiting for you. I'm happy for you. But if you don't want that, then do those three things I just talked about. It's not a takeaway in any way, shape, or form. It's just a fact. If you're not willing to do those things, this isn't the business for you. And like I said, some people, they're not meant to be their own boss. They're not good at it. They don't have the discipline and self-control to be their own boss. They like to be ruled by somebody. They like to have themselves under someone's thumb. Ask yourself, is that you? Because most people don't admit it. Anyway, I hope that you guys learned a little bit about the importance of trade management, the importance of consistency, the importance of taking your stops, and of course, having a trade tracking spreadsheet, journaling all your trades, and of course, having a proper trading plan, because those are the things that are going to help get you to the places that you want to go. Without them, you're not going to get anywhere. You're going to tread water if you're lucky. All right? I'm Jared Wesley of Live Traders. We'll get back at it again next week.